Hey there, everyone. Welcome to Chart This. I'm Dave Keller here with Market Misbehavior. Pleasure to have you join us live. We're broadcasting on YouTube, on X, and on Facebook, wherever you're participating. Thanks so much for tuning in live. Those of you that are, if you're watching this later, happy that you're joining us as well. Just so you know, I can see comments on whatever platform you're on. I can see them wherever you're at as I'm streaming. So feel free to comment along the way as we go, and I'll do my best to keep an eye on what you guys are seeing and thinking. Of course, on a day like today, Tuesday, day one of the two-day Fed meeting, really usually is a tread water kind of day. And I think as we get to the charts, you'll find that is sort of how things played out today. A lot of eyes, of course, if not all eyes on the Fed meeting, the announcement tomorrow afternoon. The market now pricing in a 50 basis point cut. That actually has changed pretty dramatically here in the last month or two, right? At one point, it was a foregone conclusion we would have a 50 basis point cut. And then a little bit later, it felt like a foregone conclusion we would have a 25 basis point cut. Then it was a coin flip between the two. And now we've pivoted right back. And so as the Fed governors talk about being data dependent, as Powell has mentioned, how, it's all about, when, whatever data comes out, whatever inflation data or economic data that they will focus their attention on incremental data points. That unfortunately is like throwing fuel on the fire of market overreaction and encouraging people to overreact to certain things that may not have a lot of signal, but everything I feel like has signal, particularly economic data, anything related to inflation. So let's talk about what we learned, and let's look at what we learned going into tomorrow's announcement. I do want to let you know that we had a poll going recently on X. I asked simply earlier today, does the S&P finish this week above 5650? Now that's the all-time high, or rounding error around our all-time high from July, August, now into September. Potentially, we're making the third peak of a triple top pattern as we retest the double top pattern. But about 2/3 of the people that responded, just over 60%, responded yes, they see the market going above or closing the week above 5650. And that would have to, basically involve a Fed that comes out probably a 50 basis point cut that essentially is priced in. The language that Powell uses doesn't shock the markets to the downside. And unfortunately, I feel like we're at a hair trigger away. We're just one bad data point away from the market ripping to the downside. But only, about a third of you, maybe a little bit more, 40% saying no, we finish below. I'm curious what you guys think as we go through the day today. And again, I would argue probably no, super additional data points to set the stage for tomorrow's press conference, sort of a wait and see mode. However, when you look at the two-day chart of the S&P 500, you can see we actually ripped pretty good to the upside out of the open by 11 a.m. Eastern. We're up around the 5670 level. But around lunchtime, we're back to flat for the day. And then the whole afternoon was kind of choppy, sloppy, just below that zero line. That's the chart you see on the left side of your screen. By the end of the day, the S&P 500 not really gaining any ground or losing any ground relative to Monday's close. So the S&P finished around 5635. The Dow, the worst performer of the three major U.S. indexes, but still just down slightly. I mean, it's pretty much a rounding error from yesterday. The NASDAQ was up a lot more earlier in the day as everything sort of rallied out of the open, but again, settled into essentially trade around yesterday's close, finished up about 0.2%. Mid caps and small caps both strong. And that idea of small cap leadership is a theme we've toyed with and talked about quite often here in recent months. I would say the IWM chart still has plenty to prove in terms of an upside breakout. But a day like today, more and more days like today, where you see small outperforming large, that usually speaks to sector leadership and which sectors are performing well relative to growth sectors, but also may indicate additional risk. At this point, I don't think of small caps as a great measure of risk on, because I would say, days like today, it's more about the sector distributions than anything, right? And what I mean by that is, when the growthy stuff, particularly technology, communication services, when those are struggling relative to things like industrials or financials, these are the types of sectors that are more heavily weighted in the small cap index versus the large cap. This is kind of the configuration that you get. But it's a healthy reminder that if you're sort of blindly owning the Magnificent Seven and just waiting for that to reignite to the upside, may be good to sprinkle in a couple small caps here and there. The VIX, again, slightly higher, about half a VIX point to the upside, still below 20. And again, I like to keep things simple. And if you follow my work here over time, you'll know that that is a theme we come back to very, very often with market misbehavior. It's all about simplifying. And I find that the financial industry in general loves to overcomplicate. We love to make things seem super complicated and imply that there's no way you as an individual investor or as a layman have any chance of understanding the markets as financial professionals do. I would love to flip that script and encourage you to recognize that you do have plenty of opportunities. And just the simple fact of having a good market awareness, understanding key levels, key movements, key trends, key momentum shifts, you have the opportunity to outperform just fine. So in terms of simplifying a perspective on the VIX, generally speaking, VIX below 20, we're in a low volatility environment. Again, just sort of generally speaking, and conditions are just not that extreme, right? Low volatility means low uncertainty, low fear, and market is probably holding up. A spike in the VIX pushing above 20 and staying there for the more protracted period of time that we remain above 20, the more and more fear, the more and more uncertainty, the less confidence, and most likely additional risk or elevated risk of further deterioration for stock prices. So I always have a VIX alert, an alert on the VIX level. If it breaks above 20, I get a ding on my cell phone. I would encourage you to have something like that as well, because that is something. Just go do something else for a while if you want, and have an alert when the VIX spikes above 20. That's when you want to pay back attention and make sure you have good risk management tools in place. In terms of interest rates, on yesterday's show, if you joined us, we talked about the 10-year yield coming down, and in fact, the entire yield curve sort of drifting to the downside in yesterday's session. Today, a little bit back to an upswing in rates as bonds came off today. The TLT was down about 0.5%, which isn't much, but certainly not up. And interest rates, of course, when bond prices are going down, that means rates are going higher. So the 10-year yield is still, pretty low relative to where we've been the last 12 to 18 months. Down around 364. The long bond yield is right around 395. Looking at the commodity space, the precious metal trade coming off a little bit. Again, not by much. I'm not seeing a lot of significant directional moves today. I think that probably is reserved for tomorrow's session, particularly after 2:30 Eastern. We usually get a lot of movement as Powell, each word is coming out of his mouth. The market's going to overreact to each one of those syllables, most likely. But for now, gold and silver selling off. The GLD down about 0.6%. Keep in mind, this is still at or near new all-time highs. Gold has made a new all-time high in the last week. Silver, again, the trend has been very, very strong. Energy prices actually doing okay. Natural gas was down slightly, but crude oil actually moved higher. And as you'll see in a minute, the energy sector was actually the top performing sector today. Finally, we have cryptocurrencies all moving to the upside and really accelerated to the upside earlier in the equity trading session. In the afternoon, they kind of came off as stocks came off as well. But Bitcoin right around that 60,000 level, up about 3% from yesterday. Ether prices right around 23.50, and that's up almost 3% as well. You can see the top 10 coins tracked here on stockcharts.com are all in the green today. Let's look at the 11 S&P sectors, and I do see some questions in there. Thanks so much for popping them in there. I'll grab a couple of those in a minute, because I do want to talk about the Hindenburg Omen for sure. The energy sector, your top performer. I don't know if I've said that sentence often in the last 12 months, but here it is. The XLE number one, up 1.4%. Industrials number two, up 0.6%. The consumer discretionary sector, XLY, third from the top, up about 0.5%, almost the same for the financial sector. If you've been ignoring banks and regional banks and insurance companies and market data platforms and all the other members of the financial sector, I don't blame you, because at times it's not been a particularly strong sector. But look now, because a lot of those charts have shown a lot of strength here over the last month or two, and certainly from a technical perspective, arguably some of the best charts you're going to see out there, outside of things like utilities, really defensive plays. In terms of more value-oriented plays, the financial sector really starting to distinguish itself from others. On the downside, we had 5 of the 11 S&P sectors down on the day. Healthcare, number one, down 1%. Consumer staples and real estate round out your next couple. As we mentioned on yesterday's show, on my market trend model, which I update every Friday after the close, and here on Stock Charts, the widget is actually updated every day after the close, just as a holding, just to give you the most recent data. But formally, I don't change the structure of it until Friday at the close, and this mirrors what we saw on Friday's session after the close. There, we had all the timeframes and all the major U.S. indexes bullish. And what that means for me, this is sort of the permission to buy check mark. This tells you that the trends are positive. This tells you to be, you should be okay taking on additional risk, or this is what I tend to think of. Don't be afraid to allocate capital in good ideas, be able to be risk on, and then wait for these to start to turn negative as signals that you may want to start to lighten up, or maybe just be less opportunistic than you were before. Just to finish off here, looking at some just updates on what we saw today. Then I want to go through some charts and I'll answer a question or two. Is to mention the Magnificent Seven. Netflix up 1.5% today. Amazon up 1.1%. Microsoft, Alphabet, both up about 0.8%. Only one of these top stocks, top growth names, that is NVIDIA, was down by about 1%. Unfortunately, that's one of the biggest weights in the S&P and in the NASDAQ. But most of these are green, right? And when the Magnificent Seven are in the green, that usually implies that the benchmarks themselves probably in the green as well. And if not in the green, probably okay, right? I mean, it's just because of the weights of these benchmark names in the benchmarks, right? They're just such, they dominate the weightings of the NASDAQ and the S&P. So following this group of stocks and just seeing if they continue to show strength, I think is pretty vital. All right. I want to get to some of the charts here and look at some of the additional inputs. We'll start with a chart of the S&P 500 just to talk about, a potential triple top pattern. And we'll talk next about some breadth conditions. Pretty sure I threw the Hindenburg Omen. I actually might not have. I'll make sure I get to that as well. All right. So here we see what is potentially what we call a triple top pattern. Now we're kind of labeling this a double top until this week. And with last week's rally, with all 5 of the trading days last week finishing in the green, the S&P was up 5 out of 5 days last week. Today, slightly higher, although worth noting that we did trade lower into the close, right? The afternoon was sort of at the lower end of the session. What that means is 56.50, and this is the level we asked about in the poll question earlier today, still holding, right? And so I don't count a move like this as a valid breakout. I'm gonna look at a candle chart just to zoom in just a little bit. Right, when you have an established area of resistance like 56.50, trading above that level intraday doesn't tell you much, right? You need to close through the level. You need additional follow through. And technical analysts of generations prior to mine, people that I learned from and respect a great deal, like Larry Williams, like John Murphy, like Tom DeMark, all have some aspect of follow through or additional validation in their work, right? And people like John Murphy just called it a follow through day. Someone like Tom DeMark or Larry Williams, a move in the direction of the breakout. They were looking for some additional validation that wasn't just a one-off thing, just a whipsaw type of move, but the beginning of something more meaningful. And the way you usually confirm that is by getting a valid close through the level to start with. So I would say 56.50, a day like today, just further supports the fact that that is the level, that is the level of resistance. And until and unless we can get a valid and confirmed breakout above 56.50, I think we're still in a basing pattern here. If we would start to sell off here, you can see the shaded areas are some of the key levels that I'm watching. 5,500 is right around the 50-day moving average, and that's the gap from mid-August. And you can see we sort of traded down just below that level to 5,400, and I think that's another key one that I would watch. So if we would get a rotation lower based on the Fed, I would immediately think of the 50-day moving average, usually a good starting point as potential first line of defense for the bulls. And I would say 5,500 is it. 5,400 would be that gap, and also the September low, now a valid swing low. The real level, though, if you're more of a medium-term, long-term investor, which I would consider myself for sure, 5,200 is the level, right? Because as long as we stay above 5,200, we're pretty much staying above the 200-day moving average. We're pretty much staying above the August low and the late May low. And overall, the structure of this market could still be considered a basing pattern. And that means you've got quite a bit of room between where we close today and those levels for plenty of fluctuation and still be considered within I would argue, a primary bull market trend. Now, that doesn't mean we can't have career-busting moves between those sorts of extremes. So I do want to remind you, let's not get too complacent, and let's remember to focus on the evidence for sure. All right, bear with me for a moment here. Boy, it's fun trying completely different technology, but I'm also figuring my way around here. What I'm going to do is bring up the Hindenburg Omen chart, which I have on the Mindful Investor Live chart list. Look at that. We can share questions. Great question. And thanks so much for sharing the question on YouTube. 3 Hindenburg Omen signals last week, back to back to back. And I guess, right, is that meaningful? What does that mean? It's a really thoughtful question. I appreciate you asking that one. And I would say, maybe, to be honest with you, the number of times when that's happened, where you've had the Hindenburg Omen light up and then have multiple days in a row where they signal, is actually quite rare, right? That's actually a quite uncommon pattern, because what that means is you have to have multiple days, and this is the one that usually limits that. That means for multiple days, you have to have at least 2.5% of the New York Stock Exchange listings making a new 52-week high, and over 2.5% of listings making a new 52-week low on the same day. And if you think about it, the reason why that doesn't happen too often is because if everything's going up, very few things are close to their 52-week lows. And if everything's going down, and we're in a primary bear market, you have very few things making new 52-week highs. But we do have that weird and unique situation that occurred through the course of last week. So the signals on the Hindenburg Omen are the market in an uptrend. The breadth swings negative, which is the McClellan oscillator below zero. And you can see the little zoom thumbnail on the right kind of makes this pretty clear. And then these histograms, if you can do the mental math, sort of multiply these by 100 and you get the percentage. These are the percentage of listings making a new 52-week high in green, so over 2.5%, and making a new 52-week low. And all 3 of those happened for multiple days. The short answer to your question is no. I don't consider that a valid Hindenburg Omen sell signal. I would say the market, the trend needs to reinitiate. The indicator needs to reinitiate, which it did at the end of last week. And now we're waiting for a confirmation. So what would we need to see to get the valid Hindenburg Omen? And again, there are plenty of people will give you different answers to this, because I feel like the Hindenburg Omen has taken on a life of its own. There's a lot of wiggle room, but from my understanding and experience applying this over a lot of different cycles, I would need to see the trend remain positive, which it certainly seems to be. I don't think that's going to be the problem. The McClellan oscillator would need to rotate below zero. And again, it does not take much. A big down day usually can get that done in a session or two. Then you need to have enough stocks still making a new high, but some of those names that were making a new low that are no longer making a new low because they're bouncing are going to have to go back down. The short answer is it would not take much. One big down day could trigger that Hindenburg Omen. Keep watching this show every day after the close. I promise I will report if and when I see that configuration playing out there. All right, let's get back to some of the additional charts here. Boy, the market recap goes quickly when I start answering questions. We'll keep playing with the time here as we continue on. All right, looking at the couple of breadth indicators I wanted to share with you. This is the percent of stocks above their 200-day moving average, percent of stocks above their 50-day moving average. The reason why I want to point this out is we are starting to get a little bit overheated in the short-term breadth, which is that bottom series. This literally looks at what percent of the S&P 500 members are above their 50-day moving average. You can see the S&P is cleanly above its 50-day. That happened last week we sort of traded below and then popped back above it. That was 2 weeks ago we broke below, I think, and then last week we sort of popped back above. So the S&P is above both its 50 and 200-day moving averages, but only 77% of S&P stocks are above their own 200-day moving average, and 77%, just over 3/4, are still above their 50-day moving average. When that indicator gets up above 80%, and I've usually thought 85% is kind of the cutoff that I'm looking for. When that happens, that's usually a euphoric extreme. Euphoric might not be the right word there, but a sign of euphoria, right? A sign that if everything's going up, there's probably not much upside to be had because it's sort of an all-in. Think of it as that last gasp higher. That's why I've shaded that area in pink. And as you will note, a lot of times when we get up into that range and then come back down, we often have a pretty significant pullback. Most recently, I would say the last time we got above 85% was here at the end of March when we had the pullback into the April low. We did get the signal in December, and that was confirmed in mid-January. That did not work out well at all because the market just continued to push higher. And that was one of those weird environments where the Magnificent Seven stocks re-exerted themselves to the upside. A lot of other stocks were selling off, but the Mag 7 names were so dominant that the benchmarks kept going higher. So really tells the story of the leadership trends earlier in the day. Got your question about the S&P 500 and whether we're in a bearish divergence. I would say, bearish divergence with breadth. Oh, thanks for asking that question. Let's take a look back here. Let's take a look back here again. Is it a bearish divergence with breadth? And I'm guessing you're seeing with this going lower and the breadth indicator going upwards. I imagine that's what you're saying. So no, the answer is no. And I will tell you, when you're in an uptrend, when the market is overall going higher, you're looking for higher highs in price and lower peaks in momentum. That would actually be, or lower peaks in breadth or momentum would be a bearish divergence. And here you actually have the market making a slightly lower close in August than July, but making stronger breadth readings. And so, what is it? Is it a bearish breadth divergence? No, I wouldn't label that way. That for me would be a higher price and lower momentum. But it is an interesting data point, I think, to your point, which is the fact that breadth is going higher, and that is true. So the advanced decline lines are at or near new all-time highs just in the last week or two. The percent of stocks above the 50-day moving average is not trending downward. So we're not getting that big breadth warning. That is one of the items on my market top checklist. That's not something that I'm checking off at the moment, because the breadth overall, I would argue, remains quite strong. To the contrary, instead of weaker breadth, I'm seeing breadth get extremely positive. And while that's not a divergence, as you asked your question, it is a concern, because when breadth gets extremely positive, a lot of times it's a negative sign. This next chart, I think, plays to your question as well, and I appreciate you asking about breadth here. This is the bullish percent index. So basically, out of the S&P 500 names, how many of them, what percent of them most recently have had a bullish point and figure signal? And what you can see from this particular chart is that we're above 70% on the S&P 500. So over 70% of the S&P 500 names are currently in a bullish point and figure signal. That's their most recent signal. If you look back, I've shaded in red over the last year and a half or so. Every time we've gone above 70%, I would ask you to focus on when we've been above 70% and when that red shaded area ends, because we come back below 70%. And more often than not, we have a pretty meaningful pullback. Now, again, January of this year did not work well. Same as the previous chart. The breadth conditions were not really good or not really helpful, because the Magnificent Seven stocks were so strong. I don't see that as the particular environment right about now, which means it's probably more similar to previous bull cycles where the trend has been positive, where the bullish percent index gets above 70. When it comes back below there, that's a warning sign. This is what I have an alert set on, is when the bullish percent index breaks back below 70%. I'll continue to follow that for sure and share with you when we get any update on that potentially meaningful breadth indicator. Just to finish off today's show, let's go through a couple of another macro chart or two. Then I'm going to get through some individual stocks and themes that I think are on the move, or from a technical perspective, are things that I think you need to be aware of. First off, Bitcoin. I think when you ask about Bitcoin, I would tell you that we're still in a primary downtrend by my reading. Today's move certainly seemed very encouraging. Great to see Bitcoin back above the 50-day moving average, back to above 60,000 as well, which it has not been above since late August. So all of that's kind of encouraging. But take a step back from your monitor. I'm particularly looking at the lower peaks, right? Just a simple trend line connecting the late July high, the mid-August high, and seeing where that lines up to current levels, I think is important here, right? And if and when we break above that trend line, which has not quite happened yet, I think that could be interesting. For me, breaking above that trend line would be great. Breaking above the 200-day moving average, even better. Breaking above the August swing high, so that I can't tell you we keep making lower highs, we're actually making higher highs. That's the completed pattern. So for me, back of the envelope, Bitcoin above 64, we'll call it 65,000 to clear that August peak. I think that's where we can start talking about a recovery. I like the fact that we've made a higher low here in early September. I like the short-term action that we've experienced. The fact that we got back above the 50-day again is kind of encouraging, but you want to see follow through. Also the momentum, right? The momentum has not been strong enough to really declare this a clear bullish phase. RSI pushing above 60 on rallies is much more consistent with a bullish phases here. So I would say Bitcoin, while I had a nice day there, I still think has some more to prove. Now, let's get to some individual stocks here to wrap out the show today, and I would start with NVIDIA. NVIDIA, the chart of NVIDIA looks a lot like the chart of the QQQ. It is in what we would, I would say, a very clear coil pattern is how we would call this. A coil or symmetrical triangle pattern is what happens when you have a pattern of lower highs and higher lows. This is a consolidation. This is the market telling you that NVIDIA is worth about $112 a share. And we're basically just trading around that equilibrium point. And even though buyers and sellers are occasionally taking control, we're still sort of in that midpoint, right? We're sort of still within that range, that coil pattern, that equilibrium phase. How do we exit this pattern? We break above the upper boundary or we break below the lower boundary. And one of those things is going to happen. Usually about 2/3 to 3/4 of the way through that pattern is when you usually get a breakout, which means we're getting very close to the point when it usually happens. If you look at a lot of examples over many, many years. Look at the RSI, by the way, just dead even at 50. It's about as neutral, almost perfectly neutral momentum-wise as you could imagine. So from this point, you're looking for NVIDIA to break out or NVIDIA to break down. The pattern itself does not suggest which direction that's going to be. It's literally a sit on your hands moment. If you've read your Jesse Livermore, which I would encourage you to do so, there's time to go long, time to go short, time to go fishing. It's fishing time, according to the chart of NVIDIA. I would argue if Jesse Livermore were alive today, that is probably what he would say about a chart like that, decidedly sideways. Airlines, a lot of them having a pretty decent day today. They came off a little bit in the afternoon, but still, United Airlines and other leading airlines up about 2.5%. UAL is now overbought. It's overbought as we're approaching the May peak. So my contrarian hat is telling me, all right, let's expect resistance. This is where you often have sellers, at the very least, a brief pullback. Look for a higher low. And that's sort of what I generally think of as the idealized pattern. We probably find resistance here as we're overbought, testing a well-established level of resistance. You look for a pullback. Ideally, a higher low above these moving averages could set the stage for a nice breakout. And if UAL can clear 56, if it can keep going up to 58 a little further, that's a monster breakout. And that's where you have to go to the weekly chart, really think about what this move means. UAL has been sideways for years. So if we can actually get out of that range and break above 55, 57 and start to clear out of this base, that could be a nice upside follow through. But if and when we get above that resistance, there are other stocks, I would argue, that are sort of caught in that sideways consolidation phase. Enphase Energy, ENPH, is in a group called Renewable Energy Equipment. You can see in a very similar pattern. It reminds me of the previous chart we looked at with NVIDIA, the chart of UAL, sort of in those sideways bases. And you're looking for a signal that the base is completed. Look at this 135 to 140 level, which we tested in December of last year, in February of this year, in June of this year. We're right back leading up potentially toward those points. We bounced off $100 a share, which is a nice big round number where we've often found support. So I will tell you, based on that basing pattern, think of as a swing trader, getting down to $100 a share seems like a pretty decent place to take a speculative position and just bet on at least mean reversion back into this range. Selling into strength, I think, makes a ton of sense. However, be careful with those and make sure you manage your risk effectively, because Enphase above 140 all of a sudden is rotating, I would argue, into a new accumulation phase, breaking out of this base. Enphase below 100 would be a breakdown of support that has been holding for 8 to 9 months. So those basing patterns, that range, can be really powerful. Look for a breakout or breakdown, and that's where I would set alerts. That's where I would be comfortable taking more of a long-term position. In the middle, this is a trade, right? This is betting on mean reversion until the trends tell you otherwise. Last chart here, then we will wrap things for the day. Bath and Body Works. We're actually starting with the weekly chart. I was taught, when in doubt, zoom out. So on the daily chart, as I'll show you in a minute here, Bath and Body Works is potentially bouncing off of support. It's had a nice downtrend going for the last 3 or 4 months. Are we at a potentially buyable point? The weekly chart, I think, shows you how important this level is. I'm looking at the unadjusted price data just to show how clearly we are testing support sort of in that $27 to $28 range. That was a low from 22, the low from late 23, and we're back there today. And again, what's great about basing patterns, it gives you a general idea of where we might find some opportunity. Here we can see on the daily chart where this recent low lines up pretty well. It did undercut that October 23 low slightly, but oversold as we're testing a well-established support level. This is where I think you need to think about your time frame, right? If you're more of a swing trader, more of a short-term trader, betting a return back to the 50-day moving average, a similar sort of parallel move to what we saw in August, I think could make sense here. As a longer-term, more of a position trader, this is where you need to think about what would tell you that this distribution period is ending. This is where I'm watching something like a weekly MACD or the weekly PPO. You can see at the late 23 low, that buy signal in November really confirmed that the bottoming process was most likely complete, and we're entering into a new phase. This is the type of chart where I like to look for a buy signal on the weekly MACD or the weekly PPO as a sign that maybe we are beginning a new recovery phase. Folks, that's our show for today. Thanks so much for joining us live, those that did on X, on YouTube, on Facebook. Appreciate whatever feedback and comments that you have. Keep them coming. We're really excited to get back to doing a live show. This will be, of course, recorded and posted on our YouTube channel, so make sure you watch all of our previous episodes if you like. For Market Misbehavior, I'm Dave Keller. Have a great one. We'll see you again tomorrow.